much, Roland. Hopefully there's a clicker. There is. Excellent. Nice to see everyone. Thanks for those people that have come in to chat to me already today. Very much enjoyed the questions that we've had so far. I've got quite a lot to get through, so I'm going to go quite fast there, and I can pick up any questions at the end. But I'm going to talk to you about delivering a consistent income in retirement. Obviously, lots of you, there's many different ways to think about a retirement income, and we'll talk through some of those. But we've got one method that we think could help you today. I'm going to zip through AJ Bell because you know who we are, but just to touch on very quickly just about the AJ Bell Investments team. We've been established 8 years ago. I was probably employee number 1 in the investment team back in 2016 when I joined. We're now running just under 7 billion across our range of funds and strategies. We've got 9 funds. I'm going to focus on our income funds today. We've been lucky enough to win quite a few awards for our investment performance over the last few years. And we have a wide range of different strategies that can help you. But let's get on to what do we do in our investment team. We have a really simple approach to our investment mantra, which is to bring to you simple, low-cost and transparent funds. It's a really easy approach that we have, which all of our funds are designed to give you an instant portfolio. So you're not having to worry about selecting what's going on underneath the bonnet. We do that for you. They're all highly diversified and they're all low cost. And hopefully many of you, I'm sure in the room, are clients of AJ Bell on the platform, and you'll have seen and be familiar with the fact that we believe the importance of low cost investing, and that's been our approach for a very long period of time. Let's get into the nitty gritty of the different funds that we have. So I'm going to focus today on our income range, and we have 2 funds within our income range. Both focus on generating an income, and both actually targeting an income yield of between 3 and 5% of your investment per annum, and that's paid monthly. And that's important today because I'll come back to that. But I do just want to touch on our growth range of funds just very, very briefly, because we do have 6 funds that are invested for growth, all targeted to different levels of risk. But we're talking about income today, but it is worth me mentioning that even our growth funds have income share classes there. So if you are investing for growth, but still like to get a little bit of income from your investments, it may be that our growth funds are of interest to you. So I didn't want to miss that opportunity to talk about that. We also actually have a responsible screen growth fund as well. That is one strategy that's focused on investing responsibly over time. I'm not going to focus on that one today. So let's get to the main topic that we have today, which is generating income in retirement. Let's be honest, there are a whole host of different routes that you can take. And across all of you in the room today, of those of you that are in retirement, you will be following a whole host of different strategies. And the reality is that actually, there's no wrong answer in this. So there's no perfect right answer and there's no wrong answer, and you'll be doing following that strategy which is right for you in retirement. And I talk about this from the perspective, I used to be a financial advisor. So when I started out, I was helping devise strategies for clients in retirement, and we had various ways that we did it. And talking through some of those ways on this slide here, there are a few different ways, and I've talked through some of the benefits that come with that. Obviously, the most straightforward thing you can do is, of course, buy an annuity. It guarantees your income for your life, but takes away all flexibility, and you're basically taking longevity risk. You're having a gamble with the insurance company that you'll live longer than they hope, which is not necessarily the nicest thought, but that's, of course, what an annuity is doing. But there are other investment strategies you can follow as well, and there are more than I've just put on here, but these are kind of the high-level approaches you can take. Fixed asset allocation, fixed withdrawal. You need to really keep an eye on your portfolio here if you're following this approach. You need to regularly rebalance so your portfolio doesn't get out of kilter over time. You've got the ability to take a flexible adjusted income. Brilliant to match the income with your expenditure, so it gives a high degree of flexibility. But again, you need to keep a really close eye on your investment strategy to make sure that keeps on delivering for you. Something I call bucketing. And we've seen this quite a lot. It's actually something I used to do for clients when I was an advisor, is allocating portions of income over different time periods. So short-term cash requirements, medium-term cash requirements, and long-term cash requirements. And you can invest differently in each of those buckets for what you need to do. And maybe blending an annuity to give a certainty of your fixed costs with any of those strategies above. They're all legitimate strategies for you to follow in retirement. Now, as an investment industry, I don't think we make this very easy for you, really, in terms of if you're following an investment strategy, are we providing you with the tools that match the way that typically people spend their money? And I thought about looking at this. I was looking at all the funds, the open-ended funds in the investment association sector, of which there are obviously a couple of thousand. And I thought, let's just take a look at what the income frequency is for those funds. Now, I'm pretty sure I'm like most people. I have monthly expenditure. My bills, direct debits, my everything is a monthly expenditure. Yet 70% of the funds available in the investment market pay their income twice a year. So we don't actually give you a huge helping hand when it comes to budgeting and cash flow planning. Okay, well, how many pay quarterly? That might be a little bit more helpful for you in your different strategies that you're following. Well, around 20% of the market pay income quarterly. So again, there is some validity there. But actually, there's only 10.5% of the market that's actually giving you a monthly income which would be attuned with the way that most people's expenditure works. So we're not really, as an industry, doing a great job of giving you all the tools that you need if you want to take income from your investments. Now, obviously, I'm talking about the way dividends and income is paid from investments. Of course, you could take capital withdrawals, and the platform is very well set up to be able to do that. But I'm specifically talking about income distributions today in this presentation. Now, under the fund rules, so open-ended funds, we have to pay out 100% of your income, the income in the fund. We have to give it all out. We can't hold any back. Some of the investments here today, investment trusts, they can hold back some income from the good years to pay it in the less good years. So it's a very different structure. Within an open-ended fund, we have to pay out all of the income every single year. And as I say, we don't make it that easy for you. We've been thinking about this challenge in my team over the last year, really, and we thought there probably is a better way to do this. Now, we have paid a monthly income on our investment solutions over the last, since we launched the funds 5 years ago. We've been paying a monthly income, but what we've been doing up until now is paying out the income that we get in every month. And that's great when we get some income in, but there are some months when we don't get any income in which case we told you we'd pay you a monthly income, and then quite rightly you say, well, where's my monthly income? You haven't paid me any this month. And it's because we haven't had any. So we thought there must be a better way of solving this problem and providing you with an income stream that is much more attuned with the way that your expenditure is and can actually smooth that out so you know exactly the amount you're going to get each month. And so very, very recently, we've actually made a change to our 2 income funds, and we've moved to what we call a smoothed income approach. And that is all about setting a payment level that is consistent through the year, that is based on our expectations of what we get in each month. And so we're able to give you 11 equal payments over the course of the year. But of course, the rules say we have to pay out 100% of the income that we get in. So at the end of the year, and this is just an illustration of the months on here, at the end of the year, any excess income that we've built up over that period, we will pay you a 12th payment there as kind of a balancing payment. So we're not left with any income in the portfolio. Now, hopefully, I mean, this illustration here, the blue bars are kind of the randomness of what we may have paid out before, and then the red line is the kind of illustrative approach of paying out this smoothed income. Hopefully, that shows that we can do a little bit of smart thinking to try and solve some of the problems that exist out there for how you take income from your investments, and we can give you a payment that hopefully is relevant to paying your bills and your expenditure every single month. And then at the end of the 12-month period, I think this is right if our financial accounting year ends here, so therefore that October payment would be the one that is the balancing payment, and you would get that additional level. So this is a change we've actually put into place for the AJ Bell Income Fund and the AJ Bell Income and Growth Fund just last month there. So this has been done. So if you are invested in those funds, you are now moving to this approach. But hopefully it's something that is helpful for cash flow cash flow planning and helpful for you in thinking about taking this approach for your investment strategy in retirement. Or indeed, let's think about it not in retirement. You may need income out of your investments for other reasons as well, which is absolutely fine. So it sits here and works well for trust cases where there's a distribution that's needed, for care home fees, etc., etc. There's a whole multitude of ways where this smooth income approach, I think, can work for you. So let's get under the bonnet a little bit more around what's actually going on in the funds. I'll move to this side so I'm not stood in front of the same people all the time here. The nice thing about the AJ Bell income funds is that they are both instantly diversified portfolios. They're highly, highly diversified. So if you invest in one of our income funds, or indeed our growth funds, a very similar picture is shown, you can see here that whichever one you invest in, you are highly diversified. You're getting exposure to an enormous range of different investments. All the way through, so the income fund is a blend of fixed interest and cash and equities. And the income and growth fund, as it sounds, has got a much more exposure to equities, just a little bit of a few international bonds at that point. Now, we were doing some work a couple of weeks ago thinking, someone asked me the question, well, how many bonds and how many shares do I actually get exposure to when I invest in one of these strategies? It was a very good question. So we went away and crunched the numbers. And essentially, you are getting exposure to well over 3,000 different equities and actually more like 8,000 plus different bonds. So you are highly diversified. You are not exposed to the risk of one company, whether it's their equity or whether their bond, whether it's their bond issuance. And of course, you can see from the pie charts here just how globally diversified you are as well. So you're exposed to different risks of economies, central banks, and dare I say it, politicians. As well, which is the one we're probably all most worried about at the moment. But what I think this does is give you the opportunity to think about having a really neat core to your portfolio in retirement, to give you that consistent income that provides you with that monthly stable income, but also enables you to invest with all of these great funds and trusts that we've brought here today for you that kind of can work alongside what we're doing in the AJ Bell income funds as well. And you can kind of almost think of that as a core satellite approach of this providing a stable, low-cost core to what you're looking to do with the interesting array of funds that sit around the outside of that. They'd probably say the reverse. If they were in here, they'd say, my fund's the core and AJ Bell should maybe sit around outside, but we'll let you decide on that one. But hopefully you can get the sense here. They're all hugely diversified, so we're trying to keep the risk as low as we possibly can. So all sounds great, of course, but how have we performed? That's a very, very fair question. So these funds launched about 5.5 years ago now. We've got the red line is the AJ Bell income fund, so the mix of bonds and equities, and then the AJ Bell income and growth fund in blue, which is much more exposed to the equity market. Of course, we're getting to that point at the start of the chart here where we were in the COVID lockdown, so we can see the difference between having those lower risk assets and how it dampened the volatility by this red line falling much less there. Obviously, the blue line was nearly all exposed to the equity market, so a very big fall like all equity markets had over that period. And then, of course, you've seen that recovery. So this is on a total return basis. This is assuming you're reinvesting the income over those 5 years. And we can see the income fund is up about 30% in that time, and the income and growth fund is up about 37% over that time. So solid, credible numbers. So it's designed as a core, steady, both designed as core, steady, long-term funds. And hopefully you can see that from the performance profile that comes there. But we're here talking about income, so it's a very fair question to say, what about income? What about if I have taken income out of my investments over this period, as some people may wish to do? So that's easy for us to look at as well. So same time period here, but what I've done is I've made the assumption of a £100,000 investment at the launch of these funds, and I've assumed that you've taken a withdrawal of £4,000 per annum, so a 4% income, and you've taken that on a monthly, equal payment on a monthly basis. And say, okay, well, we've taken that money out, you've had your income over the 5 years, your 20,000, you've had it come out of the portfolio, how have we done? Well, the good news over the last 5 years is that both of the strategies, you still would have grown your capital as well. So the income strategy would have been up to £103,000, and the income and growth strategy would have grown to £107,500 roughly, and it's provided you with that stable income over time. And that's all really due to the diversification that comes in the portfolio. Again, you can see how the lower risk income portfolio has dampened that volatility down there and has provided some capital stability over time. It's exactly what it's designed to do. And the income and growth fund taking a higher degree of risk. And of course, suffering that drawdown right at the start and then recovering all the way back. And really, I think what this is showing to you is the importance of patience in investing as well over time, because we will have these types of shocks with COVID and other things. These happen in the market on a regular basis. Shocks always feel like they happen occasionally. We should be reminded with investments that they happen every single year. The market has a 10% fall pretty much every single year. And the importance is to power through it and have that long-term approach. So we've done okay. We've provided a solid income for investors over the period, and we've also been able to preserve and grow capital as well from following the approach that I've just talked about. So if we pull that together and think about what these funds are actually trying to do and think about how they can work for you, we are looking for that long-term income. Now, we say a range of 3 to 5%. We accept that the income from all funds will vary. It depends on what's going on in the market at the time, whether it's invested more in fixed interest or more in equities. There will be a variation to that. And we hope over the long period of time that roughly we average around that 4% level, but there'll be times when it's a little bit below that and maybe times when it's a little bit above that. That smooth monthly income should help you with your cash flow planning. So know exactly, and it's perfect to know exactly what amount you've got coming in from your investment every single month. So you're able to budget, you're able to maybe use your other income, whether it's your state pension or other investments or so on. You know exactly where you stand with that. So hence making these changes to the portfolios. As we've seen, these portfolios are highly, highly diversified. They are complementary to the other managers that are here today. They're invested passively in the market, which is why we're able to keep costs incredibly low in these portfolios. So passive investment that's either market tracking, so investing in something like the FTSE All-Share, or indeed tilted towards investments that are still passive but are focused on delivering a higher income from those. So it's a nicely diversified portfolio. We do actively manage these portfolios. I've used the word passive a few times there. I can assure you we are not passive in the way that we manage these portfolios. They are actively managed. We make changes compared to what's going on in the market, how things are playing out in the world, whether we need to take a little bit more risk, whether we need to dial down risk. We will absolutely make those changes as we do across all of the AJ Bell funds. So we invest passively, but we don't manage passively. Very important distinction. And I've talked here about costs reduced to 0.5% per annum. These funds, very, very recently, we reduced the funds. As the funds have grown, we've been able to pass on the benefits of that growth to investors. It's something we're really committed to do at AJ Bell. And so these funds, when they launched, were at 0.65%. And as they've grown, we've been able to pass on that benefit and cut costs recently to 0.5%. So a really low-cost way of getting access to a highly, highly diversified portfolio that can provide you with a strong and stable income over on a monthly basis over time. So just before the red light goes, I hope all that happens is a red light flashes and nothing more dramatic to get me off if I take up more time than I should. We've talked through a multitude of different ways of generating income in retirement. I've only scratched the surface with a few here today. There are many other things that you can do, and all are valid there. So don't think that there's only one way to solve the income in retirement problem. There definitely isn't. We've seen that there are very few funds out there that deliver a monthly income for investors to make that cash flow planning nice and easy for you. So our investment industry, I think we've got work to do to give you more tools to help you manage money in the right way and that fits your lifestyle. We look to smooth that income over time, make that life as easy for you as we possibly can. And probably the biggest takeaway, I would say, is those two last points. Multi-asset, instant portfolio, and low-cost investing at just 50 basis points for the funds. We always want to make sure that more of your money is working for you rather than working for anyone else in the investment industry. So with that, with 10 seconds left, I will stop there and say thank you very much, and we're very happy to take questions from you after today. Thank you very much.